If I asked you right now what your profit margin is, would you know the exact number? Not what your collections were, not what's sitting in your bank account, but actual EBITDA margin and profit margin. Because most dentists I speak with are working incredibly hard, producing more, staying busy, yet they still don't feel fully in control of their numbers. And usually the problem is not production, it's that the P&L isn't clean. Today, I'm going to show you what a clean dental P&L should look like and what the numbers should roughly be for a healthy single dental practice. Here's what we typically see. Profit and loss statement is messy. Expenses are miscategorized. Personnel expenses are mixed in. Loan payments are buried inside overhead. Dental supplies are lumped into random categories. And when that happens, you can't clearly see if employee expenses are too high, if lab costs are in line with industry average, if your EBITDA margin is strong, or if your profit margin is decreasing year over year. Without a clean structure, you can't compare yourself to industry averages. And when you can't compare, you cannot improve. If you haven't met, my name is DJ Bhola, and we specialize in bookkeeping and financial reporting for dental practices. We help practices get clean, updated monthly financials so ownership can make better business decisions. On this channel, we focus on clear numbers, better decisions, and higher profits for your dental practice. Let's walk through what a clean dental profit and loss statement should roughly look like for a single practice owner. Income should always be 100%. From there, we break expenses into clear categories. Employee expenses at about 31%. That is the industry average. This includes hygienists, dental assistants, front desk staff, and payroll taxes. It also includes the benefits for these specific employees. For a healthy single dental practice, employee expenses average around 31% of collections. If this number starts to increase to 35% or higher, your profit margin will decrease quickly. Associate/specialist expenses. If you have an associate, this typically runs around 3.83 on average across peer data for single practices. What this really means is that not a whole lot of single practice owners have an associate in their practice. Plus, this can vary, but it must be clearly separated from staff wages who are not dentists. Dental supplies. Notice we say dental supplies, not just supplies. This category should include only dental supplies. Average is about 5.58% of collections. If dental supplies increase to 7% or 8% of your collections, profit margin will decrease. Lab expenses. Lab costs are around 5.8% of collections. This directly affects your EBITDA margin since it's tied directly to what you're producing. If lab costs increase, your EBITDA margin decreases unless your fee increases. Facilities and rent expense. Facilities expense are typically about 8.59%, which also include rent expense. These should be separated so you clearly understand your occupancy costs. Advertising and promotion expense. This is about 2.5%. If you increase marketing spend, production should increase as well. If it doesn't, your profit margin decreases without any return on their advertising money spent. Overhead expense. This includes insurance, professional fee costs like merchant services, etc. The average for this category is about 9.77%. EBITDA. For single practice owners in this group, EBITDA is approximately 35.22%. That means after operating expenses, but before interest, taxes, depreciation, amortization, the practice keeps about 35%. This is also before you pay compensation to the owner doctor in a single practice scenario. Now, compare this to a dental practice group. Group practices typically operate at around 17% EBITDA. So if you're a single practice owner and your EBITDA margin is 20%, something is really wrong. Let's make this simple. Imagine your practice collects $1 million per year. Here is what a clean profit and loss statement might look like using these averages. Employee expenses at $310,000, associate expenses at $38,000, dental supplies at $55,000, lab at about $58,000. After all operating expenses are paid, your EBITDA would be approximately $352,000. That is 35.22% EBITDA margin. Now let's say employee expenses increase to 36%. That is $360,000 instead of the $310,000. That extra $50,000 reduces your profits. Your profit margin drops to 30%. That extra $50,000 directly reduces EBITDA. Your EBITDA margin drops to roughly 30%. That is a 5% decrease in EBITDA margin simply from payroll increases. No change in production, no change in collections, just payroll changes. That is why structure matters. What makes a profit and loss statement clean? A clean dental P&L has correct categories each month, no personal expenses mixed in, debt payments separated from operations, dental supplies separated from office expense, laboratory expenses clearly shown on the P&L, associate pay separated from staff wages, consistent reporting month after month, and most importantly, you can instantly see EBITDA margin, profit margin. Without guessing, without adjusting numbers manually, without asking your CPA to explain where things went. Here's what I would take away from this video. If your profit and loss statement is not structured correctly, you cannot manage what matters. Production does not equal profits. Revenue does not equal wealth. A clean profit and loss statement shows you where expenses increase, where margins decrease, where efficiency improves. When you know your numbers clearly, you make decisions confidently. When you don't, you operate on instinct, and instinct is expensive. If you're unsure whether your profit and loss statement is structured correctly, or if you don't know your current EBITDA margin, start by reviewing your categories against these averages. And if you want help getting clean, updated monthly financials structured specifically for dental practice owners, that is exactly what we do. Clear numbers, better decisions, and higher profits for your dental practice. I will see you in the next one.